With us, Mr. Kamlesh Shah, the Group CFO of Elecon Engineering, joining us on the show. Kamlesh, hi, good to have you. I just wanted to begin by discussing the order book situation because while the revenue jump up has been strong, it seems like you're not able to backfill the orders at that rate because I'm seeing only a 10% increase in your order inflow for the first half of the year. And that too from the international business has been lagging a bit. Is there some delay in decision making, or there is expected to be a bunching up in Q3, Q4 of order inflows?
No, it's not so. So far as our order inflow is concerned, we are on track. And what we are given the guidance for the year, I think we still retain our guidance for 2,000 crore at the consolidated level turnover. As we already discussed earlier, now the company's entire supply chain management is quite robust, and we also curtail our production cycle of our products, whatever CP and EP, both what we call it catalog product and engineering product. And due to this, it appears that the order book position is lagging behind. And we already discussed in our earlier call to the various investors community also. Now that order inflow, it will not have so much relevance because the company has already discontinued the EPC projects so far the MHE is concerned. And for gear also, my production cycle also has reduced. So the order inflow and order backlog will not have that much relevance so far as the to evaluate the company's revenue guidance it is concerned.
Right, Mr. Shah, this is Vinny joining in the conversation as well. You said that, yes, you are maintaining your guidance of 2,000 crores for the revenue for the year ended FY24. That's your turnover you're expecting. Which segment do you think is mainly going to be leading the growth? And also, in terms of onboarding of new clients, has that happened? Any new clients in the pipeline right now do you have?
Yeah. Presently, the growth is momentum we are getting from the steel sectors. And we also expect the same momentum will also continue, same momentum will also start for the cement industry also, so far as the India is concerned. And so far the OEM business are concerned, this quarter we added one more OEM business, and that momentum will continue because this is our area of focus for this year and the next year going forward.
OEM remains the area of focus, but you're doing 2,000 crore in FY24. What's the outlook for FY25? And do you think the margins also can be maintained at this 24-25% band, or there is more room on the upside for margins?
So far the margins are concerned, yes, we sustain the margins, and in fact we have improved the margin compared to what we have projected 22%. Presently we are having my EBITDA margin of 24%. And we are confident that due to the products mix, which is quite healthy for us, that margin will be sustainable for us. So far as the guidance for FY25 is concerned, we are still evaluating the geopolitical scenarios at the global level, and we may take some more time. So by in Q3, we will be ready with our next year's guidance for FY25 about the revenue and the profitability.
Right. Also, Mr. Shah, what I also want to understand is in FY24 next year, it's going to be that election year as well. Anything in terms of order momentum that could be a bit hampered because of that, or how are you expecting that to shape up?
We don't expect, because when we are given the guidance of 2,000 crore early this year, that we already consider all those factors, even because this is the election year and the state level also, which may have the impact. But if we consider, after considering all these factors, my 2,000 crore revenue guidance will still continue, and we don't foresee that there will have any challenge to achieve that for us.
I was just looking at your overall split in terms of revenue. The international revenue, the contribution that's come down from 30% last year to almost 20% this quarter. Do you think this trend to continue, or there was some one-off in this quarter that the international revenue was on the lower side?
No, some of the order execution is where the delivery schedule was in Q3 and Q4. We already said about that, and particularly for OEM business where the initial supply would be in the Q3. So that is where we are. And there is also an effect of revenue recognition as per the Indies, which has deferred the revenue recognition. Instead of Q3, this will get recognized in Q3 instead of Q2.
And I'm just going through your balance sheet items. Your working capital cycle has improved quite a bit, 65 days already. Is there further improvement there? And secondly, what's the utilization level, capex plan for increasing production, if any?
So far as the working capital cycle is concerned, yes, it is good in this quarter. But we say that 70 is the ideal thing. Whichever is improvement is that this may be because of the some momentum for the period only. But 70 is the ideal situation for the working capital cycle for us, where we are concerned about that.
Okay, Mr. Kamlesh, thank you so much for joining in with us this afternoon on ET Now, giving us an understanding in terms of your margins, your revenue guidance going forward, as well as your order inflows. Thank you so much for joining in with us
Thank
this
you very
afternoon.
much.